Imagine waking up this morning, just looking up at the sky and realizing that low Earth orbit now has a price tag of $2 trillion attached to it.
Yeah, it's wild to even say out loud.
Right. It's not some futuristic projection or a sci-fi novel. It's a literal market-validated price tag. And that is exactly what happened today.
It really is a number that just, it forces you to recalibrate your entire understanding of where the global economy is heading right now.
Totally.
We aren't just talking about, a slight shift in corporate earnings. We are looking at a fundamental repricing of human infrastructure.
Well, welcome to today's deep dive. Today is June 15th, 2026. And the source material we are unpacking today is a really comprehensive daily market briefing that covers a genuinely historic day on Wall Street.
Historic is definitely the right word for it.
Yeah. And our mission today is to cut through the noise of the trading floor, right? And help you understand the tectonic shifts happening literally right under our feet.
Right, because there's a lot going on.
So much. We're looking at a new space race, a massive artificial intelligence boom, and international diplomacy. And all of it is colliding in a single trading session.
It's just this profound convergence of events. You have geopolitical stability creating this groundwork, and then on top of that, the market is placing the absolute largest bets in financial history on what the next decade will look like.
Which is fascinating.
Exactly. If you want a blueprint for the future of the economy, today's briefing is it.
Okay, so let's unpack this, because before we can talk about the rockets and the AI war chests, we kind of have to look at the macroeconomic foundation.
The boring stuff, right? But the essential stuff.
Right, exactly. I always think of the global economy like a massive construction project. You don't greenlight a record-breaking skyscraper if the cost of raw materials is wildly fluctuating, right? Or if the banks are freezing your loans.
No, you'd go bankrupt before you poured the foundation.
Exactly. You need predictable costs. You need steady financing. And looking at today's briefing, the market just got the ultimate green light. The Dow ended at an all-time record high today.
It did. And the catalyst there is actually highly specific. The briefing attributes this record high directly to the announcement of a new U.S.-Iran deal framework.
Now, real quick, before we dive into those mechanics, we need to be incredibly clear with you, the listener.
Always a good idea.
Yeah. We are analyzing this briefing entirely through the lens of market mechanics and global trade implications. Okay. We are not taking any political stance on President Donald Trump's administration, nor are we, endorsing any specific viewpoint on the intricacies of Middle Eastern diplomacy.
Right. That's not what we're here for.
Exactly. Our job today is strictly to report on how the global economy and the financial markets are digesting this framework, just as it's outlined in our sources.
And that's a crucial distinction to make, because the market isn't really reacting to the politics of it, it's reacting to supply.
Right, the tangible impact.
Exactly. The immediate consequence of this framework was a sharp drop in oil prices. It was about a 5% fall today.
Which is huge for a single day.
It really is. And obviously that hits the energy sector pretty hard. Oil-related stocks were among the biggest losers at the closing bell. But for the broader market, a 5% drop in oil is a massive systemic tailwind.
It's basically a universal tax cut for the global supply chain, isn't it?
That's a great way to put it.
Because when fuel costs drop, it costs less to run the delivery trucks, power the manufacturing plants, operate the cargo planes. So without changing anything else, profit margins for companies outside the energy sector naturally widen.
Right. That's the operational side of the equation. But there's a second pillar to this foundation that we have to talk about.
Let's hear it.
The briefing highlights the relationship between the administration and the new Federal Reserve Chair, Kevin Warsh. The market expectation that was built in today is that Warsh will hold interest rates steady at his first meeting.
Okay, so stable borrowing costs.
Yeah. Exactly. When you combine those two factors, so falling input costs from oil and stable borrowing costs from the Fed, you create what economists like to call a Goldilocks environment.
Right, and I want to just quickly clarify that term for the listener. The Goldilocks environment basically means the economy isn't running so hot that it triggers runaway inflation, but it isn't running so cold that it slips into a recession.
Right.
It's just right.
Spot on. It's that perfect middle ground.
But I got to push back a little here. Is this Dow record high really a sign of deep long-term stability? Or is it just like a temporary sugar rush from a sudden drop in the price of a barrel of oil?
Well, I'd argue the data points to something much more structural than just a sugar rush. You have to remember, the market hates uncertainty above all else.
Oh, for sure.
When companies don't know what a loan will cost them in 6 months, they just hoard cash. They don't hire, they don't build.
Right, everything just kind of freezes up.
Exactly. So knowing that Fed Chair Warsh is expected to hold rates steady, that removes the fear of a sudden spike in the cost of capital. And when capital is predictable and operational costs are shrinking, well, it creates the exact psychological and financial launchpad required for the massive corporate gambles we saw today.
And speaking of capital allocation,
Yeah.
let's talk about the biggest gamble of them all today.
Oh, yeah. The main event.
Because institutional money looked at that stable macroeconomic foundation today and decided to literally shoot it into the stratosphere.
It really did.
SpaceX made its public debut on the Nasdaq.
And calling it a debut almost understates what happened. It was a complete redefinition of the public market's ceiling.
Yeah, I mean, the stock jumped 20% in its first full day of trading, which gave SpaceX a valuation of over $2 trillion.
$2 trillion.
$2 trillion. To put that in perspective, there are only a handful of countries on Earth with the GDP larger than that.
It's almost hard to wrap your head around.
It is. But tell me honestly, how does a company operating in such an unpredictable, high-risk physical environment justify that? I mean, rockets explode, right?
Yeah.
Weather delays launches.
Yeah, the physics are incredibly unforgiving.
Right. So is this just pure, unfiltered, retail investor hype pushing a famous brand name to the moon?
You know, you might assume that, especially given the massive cultural footprint of the company, but the institutional data tells a completely different story.
Really?
Yeah. Retail investors, even, highly organized ones, they simply do not have the capital density to create a $2 trillion floor.
That makes sense. They just don't have that kind of cash.
Right. Look at the specific transactions highlighted in the briefing. Investor Ron Barron bought $1 billion worth of shares in this IPO alone.
Wait, $1 billion
Yeah.
in a single day's trading session?
In one day, yeah. And that brings his total stake in SpaceX to $25 billion.
Wow.
Right. That is not meme stock, day trading behavior. That is a flashing neon signal of institutional conviction.
Okay, so why? What are they seeing?
To understand the why behind that $2 trillion number, you have to look at how institutional money actually operates. They aren't buying a novelty rocket company. They are pricing in a monopoly on the foundational infrastructure of the next century.
Oh, so they're treating low Earth orbit the way early industrialists treated, like
Yep.
the railroads or the telegraph lines. It's the new industrial zone.
Precisely. Think about the mechanics of Starlink alone. It's not just consumer internet, right? It is a global, uncensorable telecommunications network.
And defense infrastructure.
Exactly. The institutional money is betting that whoever controls the absolute cheapest, most reliable access to space will ultimately control global data logistics.
Which is everything now.
It is everything. Yes, the physics are risky, but players like Ron Barron are looking at the technological moat SpaceX has built. The reusable rockets, the incredible launch cadence, and they are deciding that no competitor can catch up in the next decade.
They've practically lapped the competition.
Exactly. And when institutional money locks in at that scale, especially with IPO lockup periods, they are parking their capital for a very, very long ride.
Okay, so we have institutional money crowning SpaceX as the physical infrastructure of the future. But there's a second infrastructure race happening simultaneously, isn't there?
Oh, absolutely. And it's moving just as fast.
Right. It requires just as much capital, but it's entirely invisible to the naked eye. I'm talking about the artificial intelligence boom and the digital war chest being opened up today.
The scale of capital deployment in the tech sector right now is just staggering. It reflects a total arms race for digital supremacy.
The briefing gives us some wild numbers to chew on here. NVDA announced they are planning a $20 billion debt sale.
Which is massive.
Massive. And this is their first major debt sale since the AI boom really kicked off. And alongside that, we have Salesforce acquiring an AI customer service platform called Fin for $3.6 billion.
Right, snapping up smaller players.
Exactly. And expanding into broader media, Fox just agreed to buy Roku for $22 billion.
What you are seeing here is an industry-wide panic, honestly. A panic to consolidate and accumulate. Nobody wants to be left holding an empty bag when the music stops.
Yeah. But the NVIDIA debt sale is the one that really trips me up.
How so?
Let's use an analogy. Imagine you have a guy at a casino, right? And he is on the biggest winning streak in history.
Okay, I'm with you.
The chips are stacked to the ceiling, he owns the table, and the casino is practically handing him the keys to the building. But instead of playing with his massive pile of winnings, he walks over to the casino bank and asks for a huge loan to keep betting.
Right.
Why does a company like NVDA, which is practically printing money right now with their hardware, need to borrow $20 billion?
It's a really great question, and it comes down to a concept called the weighted average cost of capital, or, more simply leverage. You have to remember that Goldilocks environment we discussed earlier. With interest rates holding steady, borrowing money is still relatively manageable for a company with NVIDIA's pristine credit rating. Let's say they borrow that $20 billion at, I don't know, a 4 or 5% interest rate.
Okay, so they owe 5% on that money every year.
Right. But if they take that $20 billion, build out next-generation server farms, and generate a 30 or 40% return on investment from the massive AI demand, well, that borrowed money is basically paying for itself, and then some. It's a strategic lever.
So using their own cash is actually a missed opportunity. If they use debt for expansion, they can keep their actual cash pile liquid for other things.
Exactly. They need to keep their war chest full because the finish line in AI just keeps moving. I mean, the infrastructure required to train the next generation of models requires capital on a scale we've rarely seen.
It's an endless appetite for processing power.
It really is. And NVIDIA wants to ensure that companies like Alphabet, AMD, and TSMC, which our sources note are poised for long-term gains in the cloud space, they want to make sure those companies don't find even a sliver of an opening to catch up.
So they are using debt to build an insurmountable wall around their market share.
Exactly.
That makes perfect sense. It's about buying time and speed. And you see that same logic with Salesforce dropping $3.6 billion on Fin, right?
Oh, 100%.
They aren't going to spend 5 years trying to build an in-house AI customer service tool that, let's be honest, might fail. They are using their capital to buy out a proven competitor and instantly plug that AI capability into their existing ecosystem.
Yeah, and Fox, buying Roku for $22 billion, operates on the exact same frequency.
Right.
Whether it is artificial intelligence, cloud architecture, or streaming media distribution, the biggest players have universally decided that organic growth is just too slow. Building from scratch is a luxury they can't afford in this market.
You either buy the infrastructure outright or you borrow heavily to build it faster than anyone else.
That's the reality of it.
But what I found really illuminating in the briefing was the contrast it provided.
The retail stuff.
Yes. Right in the middle of these multi-billion-dollar digital acquisitions and $2 trillion space valuations, we get a note about Dick's Sporting Goods.
Right.
They are expanding their lids shops, the stores that sell sports hats, to 100 new physical locations.
It's an incredible juxtaposition, isn't it? It serves as a really necessary grounding mechanism for the whole briefing.
It really does. I mean, while the tech giants are fighting over invisible cloud networks and satellite constellations, Dick's Sporting Goods is literally doubling down on brick-and-mortar retail space to sell hats.
Selling physical hats to physical people?
Exactly. But I want to explore why that matters today. Why does a retail expansion even make the briefing on a day dominated by SpaceX and NVIDIA?
Because it represents the tangible hedge against all this speculative volatility.
Okay, unpack that a bit.
Sure. The market needs companies that generate predictable, physical cash flow. Tech is placing massive, almost existential bets on what the economy will look like in 10 years. But retailers expanding physical footprints, they are operating in the economy of today.
Right, people buying things right now.
Exactly. They deal in physical inventory, foot traffic, and immediate consumer spending. When institutional investors are building their portfolios, they balance those high-risk, high-reward digital bets with these stable, non-correlated physical assets.
So it's the balance in the ship.
Exactly. It proves that tangible retail still has a deeply strategic place in a balanced global economy.
Okay, so what does this all mean when we look at the big board? We've covered the macro trends, the space race, the AI debt levers, and the physical retail hedge. When the closing bell actually rang today, how did this all crystallize into market movement?
Well, the breakdown of the winners and losers paints a very clear picture of market sentiment. The top gainers were exactly who you'd expect: SpaceX, NVIDIA, and Salesforce.
And the briefing notes that the most actively traded stocks today were SpaceX, NVIDIA, Apple, Microsoft, and Tesla.
Yep, the heavy hitters.
Meanwhile, the losers were the oil-related stocks due to the Iran deal and the traditional non-AI tech companies. Kind of reminds me of a high school cafeteria.
How so?
Well, all the money, all the lunch trays, and all the attention are crowded around the AI and space table, right? Meanwhile, the oil companies and the legacy tech firms are sitting by themselves near the trash cans.
That is actually a very accurate representation of the capital flows today. The market is brutally efficient at picking favorites.
But here is my major concern with this dynamic. If almost all the active trading and investment capital is concentrated in just 5 megastocks, SpaceX, NVDA, Apple, Microsoft, Tesla, doesn't that make the entire market incredibly fragile?
I'd say fragile is the defining risk of this era. It raises a critical point about how modern financial mechanics, specifically index funds, actually work.
Let's unpack that because most people's retirement accounts are tied up in index funds like the S&P 500.
Right. And an index fund is supposed to give you a diversified slice of the entire market.
Right, that's the whole pitch. Safety through diversity.
Exactly. But when a handful of companies grow to multi-trillion-dollar valuations, they take up a disproportionately massive percentage of that index. So today, when institutional money pours billions into NVIDIA or SpaceX, those stocks swell even larger.
So the index becomes top-heavy.
Extremely top-heavy. The unintended consequence is that anyone passively investing in a broad market index is now unknowingly placing a highly concentrated bet on artificial intelligence and space exploration.
Because if one of those 5 foundational pillars wobbles, it doesn't just hurt that specific company. The whole index feels the earthquake.
Exactly. The central tension of today's market is this. You have unprecedented historic investor confidence in a very specific high-tech vision of the future. But because the foundation holding up that confidence is incredibly narrow, I mean, it's just a few mega corporations, the potential for volatility is massive.
It's scary when you put it like that.
It is. Because a single regulatory hurdle for AI, or a supply chain issue for microchips, or even a string of failed rocket launches, that wouldn't just impact the tech sector. It would send shockwaves through retirement accounts worldwide.
It is a $2 trillion tightrope walk.
That's exactly what it is.
The market is placing a massive premium on the infrastructure of tomorrow. But by starving the rest of the traditional economy of that capital, it's removing the safety net.
The market has decided what the future is worth, and it is perfectly willing to absorb that concentration risk to get there first.
Well, as we wrap up today's deep dive, let's just take a breath and look at the sheer historical scope of what happened on this single day, June 15th, 2026.
It's one for the history books, without question.
Yeah. We saw the Dow hit an all-time record high, stabilized by a major geopolitical framework with Iran that sent global oil prices tumbling, effectively lowering the cost of doing business worldwide.
A perfect macro setup.
Exactly. We saw a private space company enter the public market and immediately hit a $2 trillion valuation, backed by billions in institutional money, signaling that low Earth orbit is the new industrial frontier.
Mind-blowing.
And we watched the undisputed king of artificial intelligence chips utilize market leverage, taking on $20 billion in debt just to ensure no one else can catch up in the digital arms race.
It completely redefines the scale of corporate ambition. I mean, the sheer amount of capital being deployed, borrowed, spent, and invested to build the next era of human infrastructure is staggering.
It truly is. But it leaves us with something incredibly important to consider, and it builds on everything we've talked about today.
What's that?
Well, the sources paint a picture of a world where a space company is worth $2 trillion and chip makers are borrowing $20 billion just to keep up with AI data demand. We are building the tallest, most advanced economic skyscrapers in human history.
Right.
But if the entire infrastructure of tomorrow, the satellites, the artificial intelligence, the communication networks, is being funded, consolidated, and ultimately controlled by a handful of megacorporations today, what happens to the companies, the small businesses, and more importantly, the workers who aren't invited inside those walls?
Man, that is a profound question about the concentration of wealth and technological power. We are really watching the economy split into two entirely distinct realities.
And how that split plays out isn't just a matter for Wall Street. It's going to be the defining story of our daily lives over the next decade. Thank you for joining us on this deep dive. We've given you a lot to chew on today, so take these insights, look at your own industries and portfolios, and ask yourself which side of that divide you are standing on. We will be right back here with you next time to explore whatever the sources bring us. Until then, keep digging.